Good evening, good afternoon, everyone. This is Mark from RightLineTrading, and this is a webinar on our options portfolio. Exactly what we do to create a position, and how we pick them, and why we have such an incredibly successful portfolio. I think that the style that we use to pick options is a little bit different than anybody else. And I've looked at a lot of different options portfolios and premium services. And I think we really have it over them. And I'm going to go over all of the things that we do from steps 1 to 5 to find a position and create the optimal type of options position that we want. Now, first, just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago, and became involved in the optimization of software systems for the last 10 years. And basically what we look at RightLine is future price movement, being the result of the interaction of multiple independent variables. What we've done is to determine what these independent variables are, set them in a multivariable equation, and then seek to optimize the results. And we've developed a software system that really trades off of a very, very new paradigm and rejects the trading thesis of almost every other software program. Now, when we look for a really great options position, and we're just going to talk about buying calls or creating bullish positions, because it's the exact opposite for buying a put or a bearish position. Now, the first thing that we look for is we look for a stock that's in an uptrend. And here's a stock in an absolute uptrend. Now, what is it about a stock in an uptrend when you're placing an options position that causes the associated death of the option? And there are two variables that stocks go through in an uptrend that can never be predicted. And a lot of it depends upon, well, it really is independent of the time frame of your option. The first one is that any stock in a confirmed uptrend can go into consolidation. Now, consolidation on a stock can take place and last for days or weeks or months. If you have a call position on a stock in a confirmed uptrend that goes into consolidation, price is going to erode the value of the option, and ultimately you're going to be left with nothing. Now, the thing about consolidation is that price almost always breaks out of consolidation in the direction of the trend. The problem with consolidation is that you don't know how long it's going to last, and you have a time-sensitive instrument. So if a stock goes into consolidation in an uptrend, you can potentially be in big trouble, and it could cost you all of your money on that position. The other thing that can happen in any stock is that it can take a retracement back to support. Now, there is no way of knowing when that's going to occur. On a stock that's breaking out to a 52-week high, it can always go into consolidation. It can always take a small or a fairly large retracement to support, and then continue back to the upside. So it isn't enough for a stock to be in a confirmed uptrend. And when I mean a confirmed uptrend, I mean it's trading above support or resistance, and it's moving to the upside on multiple time frames, not only on your trading chart, but it's also moving to the upside on multiple higher time frames, so that you have a multi-time frame correlation of the direction of the trend. That stock is likely to continue to the upside, but it's the retracement and it's the consolidation that is the options killer, and a variable that is very, very, very difficult to control. Now, in looking at the way that a lot of the options gurus place positions, they move in and out real quickly, and their trend-following tools are very, very primitive. I mean, to put it mildly. A lot of them use that TTM squeeze indicator, which in our opinion here at RightLine has no predictive value. It shows you what the stock has done, but it doesn't predict what the stock is going to do in the future. What we look for are predictive tools, and I'm going to go into that a little bit later. But just looking at some of the things that we need in order to ensure that a trend is going to continue and the stock isn't going to consolidate or the stock isn't going to retrace, here's what we do. We first find a subset of stock that is at a confirmed uptrend or is basing at any given position. It may be basing at a 52-week low. It may be consolidating at a 50-day moving average, but it's in consolidation. And that's where we like to take stocks out of to open up new positions. And then we look for a very specific upside catalyst that is going to keep that stock in the move, on the move, can keep it from consolidating and keep it from retracing. And it's going to maintain a lot of momentum to the upside. And these are the things that we found that are really going to help. And these are the things I look for before placing an options position. I look for some specific upside catalyst. One of the most important is I look for insider buying. Now, it just can't be any insider. It could be Carl Icahn, it can be Warren Buffett, but in lieu of having a major billionaire investor taking a large position in a company, you look for the CEO or the CFO to take a very large position in the company. Well, I'm not talking about a $50,000 or $100,000 position. We're looking for one of these two. Whoops. We're looking for one of these two traders. Hold on 1 second here. Got to move this back. And I don't know how here. Here we go. To take a very, very substantial position in the company. Now he can, the insider can buy stock or can buy options. Options are better because they give you a strike price and give you an idea of where that insider is looking for the stock to be at a certain date. Now the other thing I look for is broker upgrades. Brokerage upgrades are a very strong mover of stocks, especially when it's more than one upgrade. And usually what tends to happen is once one broker chimes in, then another broker chimes in. So one by one, they all begin to come in. And they'll come in after a stock reports earnings and they're really, really stellar. Or they'll come in when a stock has just fallen so far and it has a predominance of sell orders that it starts reaching a value, price to earnings ratio, where it just becomes very advantageous to buy. And one of the positions we have in the portfolio now was listed in Benzinga's 5 toxic stocks to immediately sell from your portfolio. And what I saw was, and now Benzinga is a big mover of stocks, is when they released that announcement, the stock only fell about 2 or 3%. And that showed me that the hands that were holding the stock were not weak hands, they were strong hands. And it showed me that the stock, which was basing it around a price of $7, and I'm going to show you what that stock is, had really hit a bottom. So when there's a major negative release and the stock doesn't react, then that's also a very valuable piece of information. Now, options is I meant to put up here, and it's just redundant. Now, news is very, very important. And sometimes more esoteric news is more helpful than information released directly about the stock. And to give you an example, I was reading the Wall Street Journal, and I noticed that they had an article about our war campaign in Syria against ISIS. And what they said was that the United States was running out of cruise missiles because we had fired so many, and they were going to have to put in a new order. There was absolutely no company mentioned, nothing related to the buy or sell of any financial instrument. And what I did was I went into Google, I'm sorry. I look at Yahoo News a lot. I went into Google and I found what company makes cruise missiles. And it's Raytheon. So I immediately recommended a call position on Raytheon with a strike price that was 2 months out. And we made 205% on Raytheon. Now, maybe that other people saw the news as well, but the stock fundamentals got much better once the United States placed that tremendous order for cruise missiles, and Raytheon is the major manufacturer of cruise missiles. Now, the fifth thing, or really the fourth thing, is the unlock period. Now, remember, for the first 90 days that when a stock IPOs, the insiders get a very large position in the company. Almost 20% of the float is locked. They are not allowed to buy or sell the stock, and the brokerage company that did the IPO is not allowed to hype the stock as well. So there's a moratorium on information during or previous to the unlock period. Now this is the old buy or sell the rumor. Is sell the rumor and buy the news. What people look at is the unlock period as where a massive amounts of new stock are going to be released into the market, creating a much larger float and dropping the price. So moving into the unlock period, in lieu of the unlock release date, the stock tends to drop and drop and drop as investors exit, bracing themselves for the unlock period. And then at the unlock date, it tends to be the nadir of the stock price. And actually what the unlock date calls is a stock bottom. And I'm going to show you a couple of examples of that. And we have one in our portfolio right now. And it's just about coming into break even. We've held it now for 60 days. And I believe by the time we reach the expiration of the option, we'll be well in the money and it'll be a profitable position. But we bought it at what we consider to be the price nadir. So let me just go into a couple of examples. Now, this is an example of Paycheck, and this goes back to October 31 of 14. Right here was the unlock date for the instrument. You can see that after the unlock, the stock went from just below 18 to $28 a share. Now, it can take up to 4 or 5 months for this to mature, or it can mature very rapidly. In the case of Paycheck, this thing flew to the upside. So we look for that unlock period as a nadir in stock price. Now, the truth is that most people holding these insider positions don't sell them anyway because the stock price is at a low. So they hold on to them and they just ride this wave up of as new buyers come in and see that the position is actually not going to fall. Another example is Horace Medical. Now, Horace was at $4 and change. Here's the unlock. Stock went to $6.30, about a 50% increase in price in a very, very short period of time. Now, the thing about it is you don't really have to know much about the company. All you have to know is that it's fundamentally, it's got sound fundamentals and a fairly decent chance of ultimately turning a profit. You don't really have to know much more about it, except that that unlock is going to call a nadir, everyone's going to sell into it, and price is going to rise post-unlock period. Now, this is really the information that most other people hide. And what I want to show you is these are the open positions in our portfolio. Now, what I'm very fond of is buying put spreads or buying calls. Now, I placed a few naked puts, but for the most part, I'm looking to place call positions or put spreads. And these are bullish put spreads. Now, right now, I had a put spread working on Newmont Mining. It'll expire in September. It's a 32.27 put spread. That means we sell the 32 put and we buy the 27 put on the September 16th expiration date, and we get a net credit of 50 cents. Now, Newmont is currently trading at 45.41. Now, the only thing you need to know at this point is that if Newmont closes on September 16 above 32, we get the full 50-cent net credit that we were awarded. So we're going to get $50 for every vertical spread position that we placed if Newmont closes above 32. Now, since it's trading right now at 45.41, the likelihood of it dropping to 32 are nil and zero. So this is almost a lock-in position with 100% net credit of $50 a position. This is Western Digital. That's a 37.50, 35 put spread. It's got to close above 37.50 in October to give us 100% of our net credit. That's $45 a spread. It's very, very likely at 43.92 to close above 37.50. Carnival Cruise Lines is expiring in just a week and a half. It's got to expire above 42, give us 20% of our net credit or 100% of our net credit, which is 20 cents. Very likely to be another winning position. U.S. Steel, I placed a 13.11 put spread. Net credit 25 cents per spread or $25 per spread. It's trading at $22.68. That's a lock position. This is Allergan. These are all August expirations. Carnival, U.S. Steel, Allergan. It has to trade above 215 to receive a full $65 per spread. It's trading at $252.90 as of its close today. Apache, 45.40, $45 per net per spread. Has to close above 50. Has to close above 45. It's trading at 54.01. These are almost all locks on 100% of our maximum potential net credit. Now, Oasis is the only position here that is an iffy position. Now, it was a put spread with a 30-cent net credit. That's a 27% return on investment. It's got to close above 9 going into August, and it closed today at $9.09. Now, because we got a net credit of 30 cents, it can close as low as $8.70, and that's where we'll be at break even on the position. So we got to watch Oasis very, very carefully. If it looks like it may close below 9, what makes this position so easy to protect, because we're so close to options expiration, is we could buy protective puts on this position for almost no money. And we would buy the August 19 expiration puts and cover this position, or back the position up, and we can get them for just pennies. And if Oasis falls, say it falls to 8, we're going to make money on the protective puts, even if we lose money on our vertical spread. Now, the unlocked position is Square. Now, they're $12 calls, 65 cents. The stop loss is 25. Now, the price target was $2.10. I thought that Square was going to go up a lot harder and faster after the unlock, but it fell a lot after the unlock. But now it's back up to $11.35. You only need 65 cents on this position to make money on the call position. And Square actually didn't behave as well as almost all the other unlocked positions I've seen. But I have a strong confidence that Square is going to come up to 12, surpass it, and give us money on that position. And we've been holding it, I believe, for about 2.5 months. Now, here are some of our closed positions. Now, we've taken a few losses, but we've taken an enormous number of winners, and I mean an enormous number. I don't know anybody who has more wins, who posts their results. We put in a put spread on relapse of pharmaceuticals. We got 100% of our net credit, $35 a spread. Now, Delta Airlines was just a call that I purchased at $1. Just a few days later, we sold it for $1.50, and we made 50 cents on the position. And I'll tell you, the only thing that I did to buy Delta Airlines was I took a trip, and I saw how incredibly crowded it was at the Delta ticket window. I mean, they were backed up 100 miles. And I said to myself, if Delta Airlines is so packed and it's got so many customers moving through, the stock has got to do well. That was my piece of fundamental analysis on all the investigation I did. Delta was in an uptrend. When I saw that what was going on in the airport here in Miami, I simply bought calls, and we were up 50% in a very short period of time. Perrigo is a generic pharmaceutical company, 100% net credit. I had bought Relapsa again in May, 100% net credit. Bluebird Pharmaceuticals, 100% net credit. And then here's Raytheon. And Raytheon, I had told you about the cruise missile purchase. It was in a strong uptrend. These were $130 calls, or the strike price was $130. We sold at $340. We made 209% on Raytheon. Now, I don't have all the 216 closed positions. We do have, I think, 3 or 4 losers, but I don't know the exact number. We have close to 25 winners in 216. And one of the losers, which is Amazon, was really a position that I placed in 215, but I'm counting it as a 216 closed position. Now, I want to just show you how the options newsletter reads. And this is an options newsletter that went out about 3 weeks ago. And I was watching Ford because I got hammered down 10%. And I put out Q2 earnings, and the revenue beat estimates. The earnings per share, though, was 13% below last year. Ford had seen a significant slowdown in China and Europe and saw margin shrink. Ford also said that demand would be lower than last year in the second half. But that said, Ford is a core holding for dividend players, as it pays a huge dividend. And I looked at the fundamentals. Ford was consolidating right around $12.50 a share. And if it continued to hold there, I was going to place a position on Ford. Now, I'm going to look right now. I ultimately wound up not taking the position on Ford. But I'd like to give everybody the heads up. Now, Ford is now trading at $12.31. So it's real close, and we may enter a position on Ford later. Now, Conn's is it's a specialty realtor. It offers a selection of consumer goods, and this is the stock that was described by Zacks as one of 5 toxic stocks to immediately remove from your portfolio. And it used to be $80 a share. And its current price at the time that you were told to get rid of it fast was $7. And I put it right here. Here's what I noticed. Zacks is a widely followed and respected service. Nonetheless, its announcement to eject Con from your portfolio did little to move the stock down. And this suggests it has found a bottom and is currently being held by strong hands. It was upgraded by Stephens Inc., an Arkansas investment firm. The Arkansas investment firm, Stephens Inc., bought 1 million shares of the stock. So we watched it for a few days. We saw it basing around the $7 level. So what I ultimately did was I put in a recommendation for a vertical spread on Con. We sold the September $6 puts. We bought the $5 puts. Now, the net credit limit was 25 cents, but that's an incredibly high return on investment. That's a 27% return on investment. And the stock has to fall 14% to cause a problem. Now, it's currently trading at 682. It's 16 cents off of 7, but it's got to fall all the way to 6 to give us any trouble. And it's got to trade down all the way to 575, absorb our net credit before we start running a negative on this position. This is a very, very safe position. Today, in the market, Cons traded up a dime to 682, and it's been really holding very close to that $7 mark. Now, I'm just going to go into a few positions that we placed. In December 4 of 2015, the news was that employment numbers came out solid, which almost guaranteed at the time, it wound up not doing it, that the Federal Reserve will hike interest rates. And gold has sold off after a threatened rate hike. And it looks like the market believes that Yellen this time, they believe her and give gold a relief rally. But gold had come too far too fast. And the bet was that Newmont will reverse and sell off. So I bought the December puts on Newmont Mining. And here's the fundamentals on Newmont. So here is the position. December 10, 2015, increasing signs of deflation in the export and import numbers suggest that the Fed may not raise interest rates. It's time to sell our bearish bet on Newmont Mining. Last traded for 32 cents, and that was just a marginal gain. I also want to show you that we don't make great money, but we sold the Newmont puts for a small profit. Now, I want to talk to you a little bit about technical analysis. Now, when we initiated the trade on Newmont, I didn't pay close attention to the technicals. And the technicals were here. The stock was in a strong uptrend. Now remember, this can go into consolidation or go into a retracement at any time. But when a stock is in this kind of position in our software, we don't want to take a bearish position. Now we broke even on the trade because we closed the trade here and we got out of the trade. But it was a very, very risky trade. I don't want to cause confusion, because, and the thing was, after we closed it, you can see what happened. Gold collapsed in price. But this was a poor position to take, given the fundamentals of the stock. Now, Nordic American Tanker. Now this is a position taken by. What I did was I put some positions in here that were taken by other companies. And these are premium options companies. They recommended to take a position in Nordic Tanker. Their thesis was they own oil tankers, and while the rest of the shipping business is sinking, oil tankers would do well. They recommended to buy the Nordic Tanker, ticker NAT, January 16 calls. But now this is the Nordic Tanker recommendation. They're buying it off of one moving average, and that's it. This is how primitive the technical analysis is. The MACD hadn't turned yet. I don't want to get into too much. And basically, this was a very, very primitive analysis of the MACD. Remember, they're buying a call here. The MACD was to the downside, relative strength was to the downside. But what we did was we looked at Nordic Tanker. And here's where the calls were open. The calls were open when the stock was trading all the way down and had major resistance to the upside. Now, ultimately, it did break a lot of the resistance and spring up. But you can see that once it did, it resumed its downtrend, and they were closed on January for only 20 cents. They lost most of their value. So you have to pay close attention to the technicals as well as to any thesis you have about the stock. Here's another position. The Chinese devalued the yuan, and since they did, it would make goods and services manufactured overseas much more easier to purchase. And American Eagle Outfitters had the best of both worlds. They sold in the United States, but they manufactured overseas. So the thesis was the devaluation of the yuan would take American Eagle Outfitters up strong. Now here was the very primitive analysis done. Here was our analysis of American Eagle Outfitters. Now right here was trading at an inflection point. It had no background bias. The 15 and the 50 were flat, and it actually did move up for a very short period of time, and then underwent a massive collapse. And the price at expiration was zero. It had no value. That's why you have to be so careful about looking at the the technical analysis, even when you have a strong fundamental thesis for why the stock should go up, why the underlying stock for your option is going to go up or down. Nike was caught up in the FIFA bribe, and therefore it was felt that Nike was going to take a big fall. Now here is the very primitive fundamental analysis or technical analysis. It's just trading off of an upper Bollinger Band. Now if that works, we'd all be really rich if we traded Bollinger Bands, which are essentially totally useless. Now, what our analysis told us was if you're going to go any way on Nike, you're going to go long. And that's exactly the way Nike did. All it did was go to the upside. The scandal broke. Nike was caught up in it a little bit. It did pull Nike down a tad, but all Nike did was was to stay above the 50. It never really broke the 15. Everything pointed up, and Nike stock timed out with absolutely no value. CBS Corporation, without going into a huge amount of detail, another high-flying, very expensive options recommendation. They beat earnings. They had a huge amount of cash on hand. They were moving into earnings, and they had beat earnings a number of times previously. The call was to place a call position going into earnings. Here's the really again, primitive technical analysis, supposedly basing at 54. And here's what actually happened. When the position was placed, the stock was in a strong downtrend. Remember, when you buy a call, you want the stock to be moving up or be basing at an extremely low price and have a reason to not go lower. Remember, on cons, we had an investment firm buy 1 million shares of it. So we not only had the thesis for con going higher or staying where it is, we had another investment group put up their money and tell us that they were willing to buy 1 million shares of that company. Now, there was no such news on Nike. Nike was just a FIFA call. Nobody bought or sold Nike. Nobody bought or sold a lot of puts on Nike. Nike wasn't approaching its release period or lockup expiration period. And Nike just collapsed in price. And, I'm sorry, CBS. And CBS just collapsed. And the options expired worthless. Now, I want to show you some of the positions that we have placed. Now, this is Transocean Offshore. Now, when we placed the spread, it had to close above $9 to give us 100% of our net credit. Here's where we placed the position. Here's where it ended on options expiration. Now, I just want to mention a couple of other things. Here's why we use a put spread and not a call spread. A put spread, we take into options expiration, and the puts expire worthless. This saves us the commissions on having to buy them back. So we just let them expire, and we never have to exercise another trade on the position once we buy it or once we open it. So we save 50% of our commissions because it's a put spread and not a call spread. In addition, if you get caught flat-footed and the company has a release of dividends, if you're on the call side, you have to pay for the dividends. If you're on the put side, you get awarded the dividends. That's the second reason we like to place puts. And those are both great reasons. The third reason, though, that I like the most is that you have time on your side. If you place a call spread, a bullish call spread, as time goes on, the position erodes and your net credits drops. On a put spread, as time goes on, your net credit gets bigger and bigger and bigger. So even if you're running in the negative, at any time here, you know if the stock trade stays above 9, on options expiration, it's going to close, and you're going to receive 100% of your net credit. I like having time on my side, and I like the fact that on options expiration, I never have to purchase it back. It just expires worthless, and we're done with it. And right now, we have 5 or 6 positions poised. All of our positions are poised to trade or close above the bottom, the price of the put we sold, which is the higher priced put. Here was a position on Sun Edison. And you know, Sun Edison ultimately dropped to pennies on the dollar. And ultimately, I think it went out of business. But We placed a position. It had a trade right above this value. I think it was $7. It just made it above, and it expired with 100% of our potential profit. We received 100% of our net credit. This is GoPro. We placed the position here. It had a close above 25. And you can see what it did. It went into consolidation. And we got 100% of our net credit. See, when you place a put spread, you can give yourself a massive downside cushion. So the stock can fall, and you can still make an enormous amount. You still make 100% of your net credit. This is Alcoa. Here's where it had a close above, 8. We placed the position here. It expired here. We received 100% of our net credit. This is Chicago Bridge and Iron. It had a close above 40. Placed the position here. It expired here. 100% of our net credit. Now, Disney was one of the positions where we lost the position, and this is the only thing that can happen in a put spread that can cause you a little bit of grief. This occurred on Friday, 12/18. I was sitting in a pharmacy. I remember when I saw Disney. Now, Disney had a close above 110, and Disney was as high as 120 while we were holding the position. But then it started to trend down. It actually fell below 108, then gapped up and closed almost as high as 116. Then on options expiration day, and I hate when brokerage companies do this, and they know that they're going to cost people a lot of money. But what they did was they smashed Disney with a brokerage downgrade. And I don't know if it was from strong buy to hold or strong buy to sell, but they really demolished it. And so Disney crashed below our 110 line, and it closed all the way at 105 on the Friday of options expiration. Now, this caused us to sustain a loss, but this is the only time you can't control it, because you can't. There is no time to buy a protective put. There's no time to do anything. It's when information comes out on options expiration day. And I just wanted to show that to you, that we take losers, but they're very, very rare. Now, at the time I made this slide, this is from 2016. We had 15 positions. We had 12 winners, and we had 3 losers. And we've added a bunch of winners, and we've added, I think, 1 or 2 losers. I don't have to read them all off, but Micron, 100%. Rio Tinto, 100%. Chicago Bridge and Iron, 100%. Marriott Hotels, 100%. Again, Rio Tinto, 100%. PayPal, 100%. Lockup on Holistics, up 50% on a call. Smith & Wesson, we lost money, and these were both on puts, and we lost 83% on gold. Opco Kinetics, up 112%. That was just a call. JetBlue, up 50%, just a call. GoPro, 100%. Estee Lauder, up 100%. Delta, up 100%. Amazon was the biggest loss we've ever sustained. It was $388 per spread, and this was a position that was placed in December or November of 2015 with a gigantic cushion, and Amazon went all the way down to 400, and you see where it's trading today. So we had 12 winners and 3 losers on our first 15 positions in the portfolio. And Amazon is a 2015 spread purchase. And what I should have done was place a protective put. I really felt that Amazon was so strong that it would come back really hard before the spread expired, and it did come back hard. It just came back hard after the position expired. No, I don't want to go into this is more information about the 90-day lockup. And I'll just give you the time frames for these. The 90-day lockout cycle was going to occur right here. 21 days later was up 18%. 2 weeks it was up 65%. 45 days later it was up 91%. Fibro healthcare, 22 days after lockup, 16%. 2 weeks, 27%. 60 days, 47%. And it's really the thesis that I explained. You know, nobody can buy this. Everybody looks upon the lockup expiration date as being very bearish. They sell into it, and afterwards, it really tends to rebound very, very strongly. I'm just going to go through these slides. Now, the only other thing about the lockup is that after the lockup period, the brokerage company can now start hyping the stock. Prior to the lockup, they can't talk about it. And they get on MSNBC and they Fox and Bloomberg and they just talk the stock to death. And that's a nice catalyst too. Also, they're allowed to upgrade their own stock. So brokerage upgrades start to kick in. And the stock really starts to rise strongly. And it happens over 90% of the time. And it's going to happen with Square. And this is Horace Medical. I showed that to you. Eventually it was up 53%. And this is another example I didn't show you. This is Ferrari. Went public in October of 2012. And here's a lot of the metrics. And basically Ferrari hit its point of maximum pessimism right before the lockup expiration. And after the lockup expiration, the options traded for 80 cents, and they price target of 320, and look where Ferrari went. It went up like a rocket ship. So let me just move over here. Give me 1 second. I'm going to reshoot the screen really quickly. You know, I don't even really have time for it. Hold on. You just hold 1 sec. I'm going to put the slides back up. Now, I haven't talked much about the mechanics. Just hang on 1 second. Let me get these going again here. Hold on 1 second. Let me scroll down. I haven't talked about the mechanics of a put spread, and I just want to go back to this one position really quickly and show you what we're looking for. Now, you don't want to lose a put spread. Now, I just a couple of days ago recommended cons. Now, you'll notice that we get a return on investment of 27%, which is very, very high. And the stock has to fall 14% to cause us a problem. So the stock was trading right around 7. We had a $1 cushion on cons. So if we don't happen to be absolutely correct about it, and it drops to 650 or even to 630 or even to 620, we're still going to get that 25 cents, which is a 27% return on investment. And because what I'm looking for are put spreads that not only have a great upside catalyst and a great return on investment. Now, normally, For a $1 put spread, you can expect 10 cents. We got 27 cents, which was 27%. So we're looking for very specific spreads, and we don't see these often. You can get a 27% return. I have to thumb through an enormous number of stock positions, looking at different months and different at different expiration prices, because there's no formula. There's no way to automate this. But what I'm looking for is at least a 10 to 15% downside cushion, and at least a 10 to 15% return on investment. If I can get a 14% cushion and a 27% return on investment, we're looking great on the metrics of the put spread. And I have a very strong. If I didn't feel this way, I wouldn't have recommended it. And I'm pretty sure we're going to create a put spread on Ford. So I'm very confident about the cons position. That's the kind of metric we're looking for. On the naked calls that we place, we're looking for a very, very specific upside catalyst that's going to keep the stock moving, like Raytheon, like Delta, and like Square. Square hasn't matured yet. It's about 60 cents off of its strike, and that's the position for lockup. Now, what I wanted to do was to make this kind of like a no baloney session. You can do all this on your own if you can find the metrics. Now, our 1 month of the options newsletter is $129. We're going to offer it for $79 as part of the special. Now, I mean, this may sound like a lot of hype and a lot of baloney, but it's not Ford. But here's a guarantee I'm going to give you, and if you buy the month, you're going to get it in writing. I have a really, really great position that I'm going to place next week. If it doesn't make you back the $79 that you buy the options newsletter for, we'll give you your money back on the $79. And we are a very reputable company. We don't have a single complaint against us on the internet. So it's a very, very solid spread position. I don't want to take, I really do not like taking put spread positions on Thursday or Friday, because the market can move dramatically on either one of these days. And what they may do is increase the price of our put spread and give us more net credit, or squeeze the put spread, in which case we may want to sidestep it. I think this put spread is going to come in great. It's about a 20% return on investment with a 20% cushion, which is an enormous advantage. So you really have a guarantee on that 1 month. And we give you we send you from DocuSign a DocuSign telling you that you purchased 1 month of the options newsletter for $79, and on it it's going to say 1 month money back guarantee. If the first position we recommend doesn't make you $79 or more, you're going to get your money back. I think that we're going to get 100% of our credit, of our net credit on the spread. And you have to buy a couple of spreads, but if we get 100% of our net credit, you're going to make your money back easily. It's not going to be a put or a call position. The market right now is too crazy. The one position I was looking at was silver, and I'll just tell you what happened to that today. I think that silver is underpriced, and I was going to put a call position on SSRI, and SSRI today went up 11.65%, so I missed the boat on it. And one day it went up 11%, and some news came out on it today. Earnings just punched that stock right through the roof. So we missed the boat on SSRI, but that was going to be my next put spread, because I think. But now that SSRI is up 11%, we're not going to have it. So the special, I just want to put it here, is $79 per month, and you have the guarantee. Let me just take this off. And if you have any questions about how to create put spreads, feel free to give me a call. And remember, you have the guarantee on this. And almost all of our members make great money. We really, really take very few losers in the course of a year. And I don't know exactly what the percentage of the portfolio is because I don't know how to play with the metric of how much money you make on a call, which may go up 200%, versus how much money you make on a spread that returns 100% of your net credit, or 25% with giving you a 25% return. Either way, we take very, very few losers because we take very advantageous put spreads. And every options expiration month, we bank money because our options expire worthless, which is exactly what we want. We get 100% of our net credit. And the other thing that I like about it is you make money over the weekend. When the market closes on Friday and opens on Monday, the value for your of the puts that you sold have degraded in price, and boom, you have more of your net credit locked in. So that's really it. I'm going to see right now if there are any questions. So I'll have 1 second. Now I just want to say one other quick thing. When you create multiple, when you create very complex spreads like butterflies or condors, they are very, very difficult to get out of because they have multiple bid and asks on each end of the trade. Now, on a put spread, you've got a bid and ask on 2 positions. So you have a natural and you have a midpoint, but it's only on a vertical spread. Even there, sometimes you have to play with it. We don't have to worry because we just let our options expire. So we don't care about the natural or the midpoint unless we have to close early. But if you start messing with butterflies and iron condors, and you have 4 bid and asks that you have to deal with, they're going to eat up 10% or more of your profit, if you have any more, just when you scale out of the position. So I really dislike the complex positions that some of the quote options gurus place. You can't get out of them unless you give up a large chunk of your profit, and you don't want to do that. That is the beauty of a put spread. You never have to worry about closing it and worrying about the bid-ask on the 2 ends of the options you hold. I give you an absolute net credit in which you must hold for. The order is good till canceled. Now, I always give a net credit that's slightly bigger than what is going on. Like on this position on cons, because it's the only position I put in here that was just executed. Because cons did pull back about 10 cents to get us into the position. Everything is very, very easy to do because I give you a net credit limit. If you can't get 25 cents on this put spread, you're not going to buy it. So when you place the spread, you're going to sell the September 16 $6 puts, buy the September 16 $5 puts. You can buy 1 spread or you can buy 10 spreads. I buy 20 or 30 spreads. But you have to set the net credit limit at 25 cents. If you can't get that price, and sometimes we miss trades, we missed 2 or 3 stellar trade. We missed a silver trade today. I didn't get an opportunity to put it out there, but if I did, it would have skipped past our entry because now the net credit limit is dwindled because silver's skyrocketed. But we've lost some because the net credit on this position was probably 22 or 23 cents. I'm looking for the position to pull back a little bit, get us our 25 cents, and then hold. So it's very, very cut and dry and very easy to follow. The other thing is, if everything goes our way, which it almost always does, you never have to look back at the position, and you never have to close it. It's a very, very easy position to manage. The only one that I have to watch closely is Oasis. And if Oasis looks like it's going to fall, we may have to cover it with a put. Going into the last week of options expiration, that put's going to be very, very cheap. We risk very, very little money to cover our behinds on that position. So we're in really good shape even with Oasis. So let me just see if there are any questions. We don't, Eric. We don't take positions on futures. Yes, you're locked in, Arthur. If you buy 79, you're going to stay at 79. You're never going to go up to 129. I think that's only fair. You know, the number of trades we take a month are really enormously high. And sometimes I really worry that we have too many open positions in the portfolio. You're going to see that sometimes we take between 8 and 10, sometimes even more positions a month. A lot of positions. I mean, if you looked at the number of open positions we have right now, you can see it's really large. And let me look at our open positions here. Here are closed. These are, let me find our open positions. We have a lot of open positions. And I'm just concerned that sometimes we take too many. If you're worried about not having enough, don't even worry about that. I know I have it somewhere here. Oh, here, it's right here. I'm sorry. Right here, these are our open positions. We have 1, 2, 3, 4, 5, 6, 7. We have 8 open positions in the portfolio. And they're constantly turning over. So you're going to have 8 to 10 open positions all the time. That's a lot of positions. So just be careful that I don't overdrive you with too many purchases. Now, if you'll notice here, I didn't have the opportunity to put in the position we just executed on Cooper Corporation. So that's a 10th or a 9th. 1, 2, 3, 4, 5, 6, 7. That's our 9th open position. And if I recommend Ford, will be our 10th open position, and then we've got the one I'm going to recommend next week is going to be our 11th open position. So that's a lot of open positions. So you're going to have plenty of opportunities. All right, hold on one second here. What has been the percentage return per month? Text. Yeah, we do monthlies, Susanna. We don't do weeklies. And I can't give you the absolute return, and here's why. It's very hard for me to calculate, and let me just show you what. I don't know how to do it yet. If a put spread returns 45%, and that's 100% of your net credit, you're risking on the put spread $100 to make $45. Remember, we don't want this position to go against us. Actually, you're risking on Apache, you're risking $500 a spread to make $45. But remember, you have an enormous downside cushion. You're not going to get a 20% downside cushion without giving up something. So the return on investment here on Apache was just about 10%. It wasn't a great return on investment. Here, you're risking on Carnival Cruise Lines, you're risking $100 to make $20. That's a better return. Here you're risking $250 a spread to make $45. I don't exactly know how to calculate what your percent winnings are on this. And again, when you factor in the fact that on Raytheon, you make a 209% position, make 209% on just a call. On Delta, we make 50% on just a call. I don't know how to balance those when you have all of these in your portfolio. That's the problem. I just know that I personally take all the positions, and I've made really, really good money. I can't give you an exact amount. What I may do is create a scenario where everybody buys 10 spreads, and everybody buys 10 calls. And from that, we'll find out how much money you make and how much money you lose. Well, I'll get an absolute dollar figure, and that'll give us some semblance of our percent earnings. It's just very, very tough to do with this. I'm not trying to skirt it, but that's really the truth. I don't know the right way to do it, and I've looked at a million different mathematical scenarios, and I can't make it work. And the other reason I can't is nobody else. If you look at all these options newsletters, they don't produce any return on investment if they're mixed spreads and calls. That's the problem. I mean, if we just had all calls, it'd be cake, and if we just had all spreads, it would be cake. When you mix them up, it's tough. And the other thing I can do is separate them. I give a percent return on the calls, a percent return on the puts, and a percent return on the spreads. And that might be the way to go. Hold on one second here. Eric, you can go up as high as 5% of the money you're willing to risk on any given position. Actually, I would look at it this way, Eric. You don't want to risk more than 5% of your portfolio to the downside. Listen, I think you should trade 10 contracts, but listen, that's just my opinion. I mean, you want to create a scenario where if you get 100% of your net credit on, say, 90%, you're going to get $90 per spread. If you get 100% of your net credit with 10 spreads, you make $900. Here, you make $450 on 10 spreads. Here, you make $750 on 10 spreads. And 10 spreads will not eat up too much of your margin. I have a lot of spreads on a few of our positions. On Allergan, I have a large number of spreads. On AEG, a large number of spreads, and they're all going to finish in the money. Let me just go back to it real quickly here. I have to find it. Here we are. Allergan, I have a lot of spreads. I really like the company. Apache, I have a lot of spreads. And I have a lot of spreads on OAS. So I have to watch OAS. I have the calls on Square. U.S. Steel is a lock. Carnival Cruise Lines is a lock. Western Digital is a lock. And Newmont Mining is a lock. But these are later in the month. Now, U.S. Steel is going to expire August. Allergan in August, Apache August, Oasis in August, Western Digital, and Carnival Cruise Lines in August. We got a lot expiring in August. And all of these should give us 100% of our net credit. The only one threatening us is Oasis. And that's the one I'm going to watch. And like I said, it's very cheap to back up our position. And I trade more than 10 spreads, but be conservative. I mean, you're going to make 650 on 10, 450 on 10, 30 on 10. And remember, when it's a 9-8 put spread, you're risking a lot less than when it's a 45-40 put spread. The bigger the space between the two puts, the larger the potential loss. But I'm going to cover you with a put if it looks like the position is in jeopardy. I'm not going to let this fall through the $40 level. to give you 100% net loss, 100% loss. It's only happened once in 2.5 years, and I let it happen on Amazon. And it was really a miscue on my part. All right, let me just hold on 1 second, Eric. Actually, Arthur, I really sort of told you that. I mean, I'm looking to place the put spread. I only place put spreads where I get this kind of information. And, I mean, this is really critical to me. I want to see insider buying. I want the CEO or the CFO to take a very large position in the company. If they don't, I'm not placing the position. I don't care if it's in an uptrend, or I don't care if it's basing at a low. A stock can always can break out of consolidation and go lower. I want upside catalyst. I want that CEO or CFO, the guy in the know, and it's not, and nobody even lower than this. I don't want a mid-level employee. I want the CEO of the company or the CFO to take a very, very large position. I want to see brokerage upgrades, and I want to base it on really good news, really solid. I mean, I knew that Raytheon was going to go up. I knew that Delta was going to go up, and you see a lot of the theses that other people create that doesn't include with it some kind of insider buying or brokerage upgrade is really going to be a problem for you. And the unlock is a very, very, very strong time to scale into a stock or scale into an options position 90 days out. That's really how I pick them. It's just very laborious because, again, you can't have a screen. There's no stock screen. There's nothing. Stocks in an uptrend, you know, if you want to scalp them for day trading, are great. But if you want to take a 1 month, 2 month, or 3 month spread position, if they start to consolidate or they start to retrace, and you're just in a call or a put position, you can really get burned, and you can wind up with the options expiring and you take 100% loss. That's why I'm much, much more conservative with the spreads. And remember, you can lose a lot more than you can win on every spread. I want you to understand that. That's why we have to be so cautious, and we have to move in and protect our downside if the spread position looks weak. But protecting it is very, very easy. And I've really only needed to protect one position. I didn't, which was Amazon. So we're looking for a major catalyst, and if it drives the stock up, but not enough, we still have that huge downside cushion to protect us. And I watch that cushion every day on every position, because if I have to put out a recommendation for a protective put, we're going to do it, or we may close the position early. Although I'll tell you this, we've never closed a put spread early yet in 2.5 years. We have kept every put spread till they mature, with or without a protective put. And we really don't take a loss very often. It's very, very unusual. If you participate, hold on, I've got so many. Hold on 1 second here. I want to go down to all the questions. If you want the price for a year, just give us a call. Let me put my. And we can send you a link. You'll get a substantial discount. Let me just put on my number here. We'll go to the last slide. And I'll show you our website. Now, I trade the Forex every morning from 7:30 to 8:30, and I trade futures from 8:45 to 9 till about 11:30. We're at 1-855-765-6681. But everybody who attended is going to get an email very shortly. And what I'm going to do is I'm going to take us out of here, and I'll bring up the website on Chrome. It's right here. And if you view all our products and go to our options newsletter, you can see it's $129 per month right here for checkout with PayPal. Now we're going to send you a link for $79 per month, and that will be locked in on a month-to-month basis. But we're right here, RightLineTrading, www.rightlinetrading.com. Here's our phone number, and you can contact us anytime. We're here, not 24/7, but like 7 in the morning till 5 o'clock in the afternoon. Now let me just try to go get all these questions in. We do have annual pricing, Eric. Just give us a call. We'll give it to you. You know, I don't know the return per month, Eric, but for the entire 2016 calendar year, we only have 3 losers. And as of the time of that slide, we had 15 winners. So we're making a considerable amount of money. And I really haven't calculated the percent return. I'm going to be honest with you. I could give you a number. It would be very impressive. We don't have an SMS, Arthur. We just do email, but that's the nice thing about spread positions. If you don't see them until the evening time, you're still going to get the trade. Remember, the spread cost or value doesn't really vary that much. You're going to get the opportunity to put in that limit order, and you're going to get the trade as long as you check your email every night. You know, we're not selling calls. Weekly calls on, you know, that can go by that can speed through your position in a second, and if you don't buy them immediately, you're going to be left in the cold. As long as you check your email once a day, you're going to be fine. And I usually send them out at night because that's when I finally finish my look through on all the positions and find the most advantageous ones in terms of information. And I'll tell you, I mean, I'm not going to hide it. I'll give you a tip. What helps me out an enormous amount, and I'll open this up for you on a different browser, is this data feed. And I don't buy for them, believe me. I don't market for them. But it just is really, really tremendously advantageous for me. It's Benzinga. It's not cheap. And I'll tell you right now, we do get it for free. But I'm not promoting them. But they tell you all the insider buys and sells. They tell you all the big options trades that are crossing. I don't have time to look at them in the middle of the day. I just look at the feed at the end of the day and see what's crossed and on what companies. And then I go to the and I look and see whether or not we have a really advantageous option on some insider position where they're taking 1 million shares of stock or $10 million worth of stock, or there are multiple brokerage upgrades, something that's going to get us into a very, very safe position. And Benzinga Pro really, really helps me out. I would say that this for me is gold. Yeah, and I usually like to place 10 spreads. Mimo, we're going to hold the position until it expires. Sometimes it expires in 1 month, sometimes 2, sometimes 3. I don't go more than 90 days out. If we do go more than 90 out, I just find that, you know, whatever upside catalyst that we've got, it just loses its power. I want to try to close the position in 45 days if I can, but remember, we have to, as we get tighter with the time frame, it's tougher and tougher to get a large downside cushion and a really big return on investment. That's why it takes such a long, it's so laborious to find these positions. If we went 90 and 120 days out consistently, it'd be super easy to find a spread position that gave you a 20% return on investment and a 20% down cushion because it's so far out. They're just too risky that far out. 90 days is the max that we're going to go. And most of the positions are 30 and 60 days. Arthur, what we do is, on a monthly basis, we hold options webinars, and all the members of our webinar of our options webinar newsletter are the only ones who come into that webinar. And I talk about our positions. And that's where I really teach you about the analytics of a put spread, and and exactly what you're doing, exactly where the midpoint is, exactly where the natural is. So you don't even have to. You need to get a quote, but you know where your break even is, and you're really going to see exactly how a put spread behaves, and you're going to see why, in my opinion, it's much better than buying a call spread. We don't ever want to touch that position once we enter it. We just want to let it go to expiration and let it vaporize. And the really nice thing is, I found is that a lot of options, when you go towards options expiration, it's very hard to price a spread because the bid and ask widens because the value of the spread the value of the underlying put gets so tiny. So when you close the position, you know what the potential 100% return is. If you buy 10 and your net credit's 45, you should be awarded $450. A lot of times it doesn't happen until your portfolio's reshuffled after options expiration. So you get a little bit of a bump up more than what you close with on the Friday of options expiration. When you go back to your portfolio on Monday, it's bumped a little bit more. And if you carefully go over each position, you'll see which position hasn't awarded you 100% of your net credit when it should. And it's kind of nice when that happens. It's like a little gift. Yeah, 2%, Eric, is good for what you should risk on any position. On any, yeah, it's definitely better than 10% per month, easy. And like I said, Arthur, you're going to have plenty of time, as long as you see the email the same day. Plenty of time to call your broker or put it in on the computer if you have a computer interface, which is probably cheaper. I mean, you can see right here, I use TD Ameritrade, and I use Thinkorswim to place my positions. They're inexpensive, and I only have to place them once, and then I'm out. So that's it. You'll be getting the email shortly with the $79 link and the guarantee. And if you want a yearly subscription, just give us a call, and we'll send you a link, and I'll have Rory to work it out for you. So thank you, everybody. Okay, hold on 1 second. Can you place? Hold on a second. Can you place exits for positions to cover works against you? Eric, here's why we don't do that on a call or put position. I always put in a stop. But on a spread position, let's say the spread goes against you quickly. Let me just take this off and bring back the slides. If it goes against you quickly, but still, like on this, I mean, for instance, let's just take the Carnival crude. Let's take the X, U.S. Steel. You place the 13.12 put. You sell the $13 puts. You buy the $11 puts. You get 25-cent net credit for each spread. And I don't remember where U.S. Steel was when we opened the position. It was at least 20% above 13. Now it's almost 100%. Well, it's not quite 100, but it's about 75% above. I mean, this is a lock. But let's say in the first couple of days, it moves against you. It moves down. Well, the put spread is going to become negative. You're going to be losing money on the spread. But if it stays right there and doesn't fall any further, each day that loss begins to diminish as the price of the underlying puts fall in value. So for any given loss, any given metric of losses, they're going to diminish with time. That's when time is on your side. It's very risky to close the position too early. It's a much better option to back up your position going into the last week with a really cheap put that only costs a couple of cents. If the spread, like on OAS, closes above 9, closes at $9.01, you're going to get 100% of your net credit and just lose maybe a small portion of that, maybe 5% on buying super cheap puts in case it closes below 9. And really what we're looking at really here is to close below $8.70. That's where you become you go into the negative. We don't want it to close below 9. So we would put a put spread, we would put a put in with a strike of 9. And as it fell below 9, that put would go into the money and become more and more valuable. As the put spread became more and more at risk. And if the value of OAS was $8.50 at the close, we would lose 20 cents per spread, but we'd make nice money on the put that we purchased. So that's how we cover ourselves. We don't really close, but if a position goes against you in the last week of options expiration, it's super cheap for you to cover it. Super cheap. You know, listen, right? If the position, I don't really care how the market goes. I mean, really, the market's irrelevant. When I see that the market is really what I think is starting to top out, what I start to look for are the stocks that have crashed and burned already, like Ford, like CONN, Con. I'm not looking to go on with the high flyers. I'm looking to go with the stocks that I think are being held now by just the super strong hands. That in a huge, strong downdraft, those stocks are going to hold because it's really being held by mutual fund managers simply for the 5% dividend on Ford. And they're holding it with a time frame of 5 years, 6 years. They're not going to sell it. And that's what I saw with Con. I mean, when Benzinga puts out a warning that says, this is a toxic stock, get rid of it. And a lot of people read Benzinga, especially when it's sitting right under your stock under news. I mean, that's how I saw it. It said, you know, 5 stocks to sell now, 5 toxic stocks for your portfolio, and in it was CONN. And I looked at what happened to it that day, and it really didn't fall at all. Now, what I'm waiting for on CONN is the brokerage upgrades, and I know they will come when the stock has really been proven to be at a bottom. I don't think that we're going to see $6 on Con. It's got too much cash, and it's got a very, very lucrative overseas market. So I think that Con is solid there. So that's really, I mean, that's really how we place them and what we look for each day. Yeah, I mean, we have a lot of oil stocks. We have Anadarko. We have OIL, and some of our best positions have been stocks. They have given us the best returns. And listen, a couple of the ones that we placed, we had a put spread on Cheniere, and Cheniere just made it by a whisker. So they're also the riskiest. But I loved Apache at the bottom. It came off the bottom. It's now at 54. We got almost 10 points on Apache. I mean, that's a lock. U.S. Steel, I can't remember what it was, but it's way above. And when the market looks toppy, that's what we look for. We look for the stocks that really, really have already been beaten to death. And remember, if they've fallen in a huge amount, the spread position is big because the puts are worth a lot of money. So those can be that can be the low-hanging fruit in a market like this, where we believe that it's really getting a little bit hard. And you know, market breadth is decreasing. The market is going up, but fewer and fewer stocks are moving up with it. And with market breadth decreasing and the market still rising, you know, you have to be very, very careful in your choice of put spreads. But I am, and that's why I was looking at a silver spread to add. But the silver jumped 11% today. That's why we're in Newmont Mining. We're looking at the precious metals. Because if the stock portfolio or the S&P 500, the NASDAQ, really gets beaten up, the price of gold is going to go up, and silver even further. So that particular spread on SSRI is gone. We're not going to grab a stock that just ran up 11%. The value of the puts are small. The calls are worth a lot, and I don't want to take a stock that's up 11% in one day on a spread. But that's what we're looking. We're looking to shy away from tech and move into healthcare, move into stocks like U.S. Steel, Carnival Cruise Lines that will benefit from cheaper oil. And what I liked about Carnival was the fact that it was awarded the route to Cuba. So very soon, Carnival will be the only cruise line that will be booking passage to Cuba, and that's a very lucrative market. There are a lot of people in this country that would love to take a cruise to Cuba, and the only way you can do it is on Carnival Cruise Lines. And when I heard that and looked at Carnival, that was for me the cue to move into Carnival, and we're gonna get Carnival. I mean, it's up almost 4 points, and we got a very short period of time to go before this is going to close. So listen, I'm gonna. It might be, Eric. I have to look at it, but that CDE is definitely a potentially good choice. So listen, I got to go because I don't want to run overtime, it's getting late. We're on 90 minutes. So listen, we'll send out the email. I think it's a very, very conservative strategy, and that's the only way you're going to make money in this environment. If you buy the high flyers, you can get crushed and wind up with no money. And on a spread, you really want to take ultra conservative positions. And right now, I think buying puts and calls are very tough because the market is so twitchy. And any call you buy on any high flyer is going to cost you an enormous amount of money because they're up so much. That's also the problem. But a put spread is going to award you very little as well. That's why right now we're looking for the, like X at the time was worth, these puts were worth a lot because a U.S. Steel had come down an enormous amount. Western Digital down an enormous amount. Oasis was down from $50 or $60 a share, and Square was trading around 9, about $8.50 or 9. It's now up to $11.35. We need 65 cents to get to 12 by September. We have 5 weeks, and I think we'll make it. So listen, everyone, have a really great evening. If you're interested, you're going to get the buy offer very, very shortly in your email, and you'll also get a copy of this webinar if you'd like to listen to any part of it again. You're welcome to call us anytime here at, on the website. We're always here, and I really stand by these positions. I mean, you know, this is an educational service, but I'll tell you right now, these are all positions I take. I mean, I feel. I mean, I'm trading with my own moolah, and I want these positions to be successful. And I really like trading put spreads. And once a month, I usually get a very, very pleasant surprise, which is the expiration of all our positions. So listen, everyone, have a great evening. Let us know if there's anything else, and we'll be sending all that stuff out. Take care and have a really, really wonderful evening. I'm really, I have in mind that everybody needs to make money. And that's, you know, if you see the way I trade futures and the way we trade the Forex, we try to make everyone profitable. I mean, that's really our goal here. We're not short-term players in this business, and we're really genuine. So take care and good luck, and maybe you'll come into our trading room and check it out. But all the material on the options are coming your way. Have a great evening. Bye-bye.